Welcome to IVoT Ion Investing, where our experts look at the economy, the market, and particular companies from a long-term fundamental perspective. IVoT Financial Training Inc. is a company committed to making financial mastery accessible to everyone. To learn more, go to IVoT.academy. Today on IVoT Ion Investing, Ed and Andrew walk us through how the Fear and Greed Index is calculated and how to interpret it as an investor near term. Emile adds some IVoT insight into how to use near-term market sentiment as a long-term investor. Then Emile uses the IVoT Forecaster tool to do a fundamental analysis of Nike based on its recent fiscal first quarter 2026 results reported on September 30th. Nike has been a terrible performer for investors over the last 5 years, declining over 40%, and is down 3% this year, compared to a 15% rise in the S&P 500. One would think, given this poor share performance, that the shares might look cheap at this point. But do they? If you are a member of IVoT Academy, get out your IVoT Nike Forecaster and play along. Let's get started.
Hello, this is Ed Butowksy. Welcome to today's show, IVoT Eye on Investing. Today we have the co-founder and CEO of IVoT, Emile Westergaard, and our strategist, Andrew Tang. So thank you very much for joining us today, guys.
Thank you for having us.
So I want to start off with Andrew talking about the Fear and Greed Index, which is so important to analyzing the condition of the overall stock market. So Andrew, can you take us through that a little bit?
Sure, absolutely. Yeah, the Fear and Greed Index, the one that I predominantly use, it's from CNN Money. And this indicator, it's dubbed as the Warren Buffett indicator, right? Because it's a meter, we should put the screen of the chart right now. So you can see that this is a meter based from 1 to 100. Okay, so extreme fear is towards the lower end of the meter of the 100, and extreme greed is the other side of the spectrum here. So you'll see that. So it really jives with Warren Buffett's saying is that be greedy when everyone is fearful and be fearful when everyone is greedy. So this is a contrarian approach to market sentiment. And the index is actually quite sophisticated because there are 7 key components in there. For some, if you can just follow along, I'm not going to spend too much time digging into it. So stock price momentum with the general index prices compared to their moving averages. So the strength is, if they're hitting 52-week highs or not. And then there's what's called the market breadth. And that really measures the volume, right? The volume has a lot to do with the market breadths, in rising stocks versus falling stocks. So that's called the breadth. And then for options, there's put and call volume that they see. So if there's a lot of call options on the index, then it's more bullish, more greed. And then if there's more put currently outstanding for the index, then it's more fearful. It's less bullish, right? It's more bearish. And then there's junk bond demand. If there's a lot of demand for junk bond or the spread compared to treasury for junk bonds, if the yield spread is normalized, right now it's actually very low. So if it ticks up, then it's like, hey, then we might have some risk in the system or might have some problem. But right now it's still very low. And then there is market volatility.
Junk bonds, just to be clear, junk bonds are bonds above what rate of return?
No, it's below.
What rating?
What rating? I believe it's double B. It's double B or below.
Double B or lower.
Yeah, double B or lower, it's considered junk. So that's why double B is the borderline. And actually that's a lot of bond managers' favorite, right before the rate cuts. But anyway, okay, so and then the next component is the market volatility, which is the VIX that we talk about, the VIX index. Uh, Very often we use it, anything below 20, it's normal, and then 20, it's a cause of concern, and then 30 is crisis mode, right? And then safe haven demand like gold and treasuries, right? So you add all these seven components and to give you this really amazing meter. And then the second chart that I'll show you is that when we map that over time, you will see that whenever it approaches to extreme greed, it doesn't stay there for long. Same with extreme fear. It never stays there that long. So if you simply use these indicators to basically lean towards, hey, how you're going to posture your positions, I think this is very helpful. At least it will give you a macro or a high level overview in terms of trend of where the money is going to. Is it going into the markets, or is it risk on, or is it risk off? You don't necessarily have to be on and all out, but if you have some type of indication to give you that little bit of additional information, I think that's very helpful.
And and IVoT is focused on fundamental investing. This is more geared towards trading and short-term swings, the fear and
Correct.
greed index. So if you're going to follow that, that's going to be more very contradictory to what Emile and IVoT is all about. But it's an interesting thing because everybody always wants to know what's going to happen to the market in the next hour, not the next month or quarter or 6 months. People
Yeah,
know what's going to happen instantaneously.
correct. So
Let,
this
let
is
me
this tool is not used for short-term trading either. So the fear and greed, it's a little bit more intermediate and not designed to use for short-term. And I interrupted you, Emile. Please go ahead.
No. Well, I was going to say that even when you're buying shares long term, you're buying them, right? So you're deciding now is a good time to invest long term, or do I wait and hold off? Not that you're trying to really time the markets, but at least you know what you're getting into. So that's one thing, right? So in this case, you can see here when the index here is hitting on the red, then the market's afraid, right? I'm not, I mean, the market's greedy. Is that right?
Yes, it's extreme
Yeah.
greed. Hmm.
Right. And then when it's green, it's funny because exactly it's antithetical. So this is when everyone's feeling good, but this index tells you to be careful.
Yes.
In green is when people are afraid, and
Yeah.
that's when the fear greed would tell you, well, now's a good time to go in and look for deals. And
Yes.
I think as investors, we're always looking for deals. So I think this is still fine, even for a long-term investor, as a way to at least understand the current environment. The other thing is that we do use, Andrew mentioned volatility, which is a component of the index,
Yeah.
of this fear and greed index. And the volatility of the VOO, for example, the S&P 500 might range between 10% and 30%. 10%, again, meaning everyone's feeling pretty good and greedy, meaning low volatility, low risk expectation, and then 30%. Oh my God, you could lose 30% of your money in the S&P 500 right now. You better be careful, right? It's pretty much as simple as that. It's how much is the market saying you could lose? And just to be clear, those numbers, the volatility comes from the options market. It's a mathematical calculation. It's not a opinion. It's actually a mathematical calculation based on options pricing of the current riskiness of the market. And so at IVoT, actually, we use that quite a lot. That's kind of a core way that we look at the risk of the index at a given point in time, and also at comparing risk of companies, because there's a volatility not only for the index, but there's a volatility, and I'm going to stop sharing here, there's a volatility for each company, right? So if I look at a company like, typically something that's considered a low vol investment will be Johnson and Johnson. Johnson and Johnson might have an implied volatility of 10 to 15% on the high end. It's always pretty low down there. Whereas right now, I think if you looked at Tesla, it's got an implied vol of 50%. which again, if you translate, means your downside risk in Johnson & Johnson's 10 to 15%, your downside risk in Tesla is 50%. Now, there's a lot to talk about what those numbers really mean because they're a little bit sophisticated, but we're not going to do that right here. But in any case, when we look at stocks as long-term investments, we look at the return, meaning, and that we'll do that in a minute with Nike. What does the forecaster tell you the stock is worth? So let's say, I think we looked at last week at some very cheap stocks like Pfizer. We said, well, wow, it's worth, depending on how you look at it, I think we came out around $45, $50 and it's trading at 23. That's the return, right? That's about 100% return, let's call it. And then you have how volatile, how risky is that return, right? So if I look up the implied vol and I say the risk is, the implied vol right now is 20%, then that tells me not only the return, but the amount of risk I'm taking. And again, at IVoT, we have tools that help you do that and calculate how much to buy based on that riskiness along with the return. On the other hand, if you had 100% return in Tesla, but it was a 50% vol, it would tell you that that's still 100% return, just like J&J, but a riskier investment than the J&J. And that's basically, I think, probably enough for everyone on this topic. But I think, Ed, looking at risk, even as a long-term investor, and how to think about what you're doing to your portfolio as a whole when you add positions is very important, and absolutely something that we get into at IVoT.
So let's get into one other subject before we go to Emile's analysis of Nike. And Andrew, why don't you tell us about the implications of the government shutdown on the markets, not just the stock market, but the bond market?
Yeah, so the bond market is not reacting, too extreme, to that degree, because if we look at the 10-year yield, it spiked up a little bit, but it's actually it's down today, still hovering around 4.4, somewhere around there. And the government shutdown, I have to say, this is the story of boy cry wolf, many, many times. And in the past, what we have seen is that pre-open, you see a huge dip, right? Those are mostly from program trading, the algo generated trades, and et cetera, et cetera. And then once it's open, human interaction, and you'll see a quick recovery on that. So we don't see that kind of activities anymore because they have programmed to ignore the headlines, the meta tags that says government shutdowns. So far, if we look back in history, each time the government shut down, it's literally short term, meaning it's resolved within 12 months. And also the market generally tends to go up. Okay. And in this particular instance, this time around, some of the federal workers are actually being laid off instead of have their pay furlough and be made up for it later on. And so far, the disruption, I think this market has been battle tested. Especially with this administration, the volatility is quite high, if you know what I mean. And it's turning out to be a non-event. And so that's why the general market is not really paying much attention to it. On the other hand, what really it's more important was the downward revision of the labor or the jobs data. And so that seems to be more present, than the government shutdown news.
Yeah, my clients haven't really been concerned. I haven't had anyone talk to me about the government shutdown being an issue.
Interesting. And yeah. What's your take, Andrew, on the jobs data? Is that something that is concerning to you, or does that mean we get more rate cuts coming, or what does that mean?
Yeah. Right now, what we're seeing is a transition period, right? Because of this economic boom from innovation and technology, and namely in artificial intelligence. So the general trend it's really shifting on the jobs demand, right? So we're seeing a lot of jobs that are being reduced and not many new ones that are opening, for example, in government and manufacturing and tech, entry-level tech and white collar and retail logistics All these areas, they are having job reduction. But at the same time, it's being offset by the job creations that are not being filled, right? Namely, in the high tech area, AI, robotics, automation, and surprisingly, is healthcare too. It's not really surprise. I mean, we all know that with aging demographics. Uh, Social assistance, because it takes a lot of morale, to fill those positions. Again, healthcare, nurses, doctors, same thing. And there are still a lot of scientists that need it too, engineers, scientists. So you'll see the shift in the jobs data. So sure, are there going to be layoff? Absolutely, because if there's any kind of a glut or excess or a pullback in demand in any sectors, those jobs, whoever currently are in those jobs, they will really have to find a way either to transition to other sectors or take early retirement, or sometimes they go further, educate themselves and go to trade schools, et cetera, and get certified, get educated. So all these things are happening right now, and the weak jobs data really tells us that we really need to review our way of collecting data. That's one. Well, now we're not even getting any data because of the shutdown. But that's okay. The market kind of knows what's going on. And with this continuation of shuffling of between jobs within the different sectors, it goes to paint a picture of a weakening jobs data combined with a somewhat tamed inflation, and that really secured the future rate cuts that we're expecting for the US interest rate to head towards the neutral zone between 2.5 to 3.5%.
So one of the really cool things about IVoT are the calculators and the forecasters. So Emile, can you take us through the Nike IVoT Forecaster, please?
Yeah, sure. And again, the forecasters are tools that help you do a fundamental analysis of any public company. We build tools for every public company. They're each their own tool, but they follow the same logic. We teach you on the platform how to use that tool. And by the way, those tools are being designed to incorporate AI so that in the future, your fundamental analysis will be able to capture a lot of information that you might not be aware of and incorporate it into your own personal forecasts and valuations of public companies. So if I go here to our site, let's go there, and here's our site. And these are our training programs on how to use our tools. I'm going to go to my toolbox and I go to the investment tools, and let me just close the other ones and we'll just look at Nike. We did AT&T last week. I think we've done NVIDIA recently, but let's look at Nike. So again, Nike, just as a little bit of background, has had a really lousy 5-year run, down about, what is it? I have it in my sheet. I think about 40% over the last 5 years, 35. So it's been a terrible investment, and the brand seems to be degrading. It's down so far this year. In fact, let me just hit those numbers before I hit the tool, just so we have a context. So let's see. So far this year, I have Nike, which is currently trading currently trading around $72. So that's down. Year to date, it's only down 3%, but down 40. I'm sorry, I was low, down 46% over the last 5 years. So It's been a real, mess. And by the way, one of its biggest competitors, if not its biggest competitor, Adidas, is also down 33% over the last 5 years. So this has been a rough run for these kind of sports brands here.
Yeah, and I have to jump in here real quick because I think that really coincides with consumer confidence too, because of those that are in the jobs that are not secure about their jobs futures, that really is a huge contributor to the lower consumer confidence levels that we have seen, going back to the 1980s, actually. And so that's no surprise that from 2023 all the way to now, Nike and these retail brands, many of those have actually retraced significantly. So back to you.
Yeah, and just again before we go to the tool, I guess the question would be, along with consumer confidence, what is it that's caused Nike's business to do so poorly? And when you see the tool, you'll see it, right? This quarter they just reported was not a very good quarter. It was better than last quarter, which was a disastrous quarter. But so sequentially it looked okay, but it was still they're losing cash flow year over year pretty substantially. You'll see that in a minute. But why? And maybe it's good to discuss why and then hit the tool. But I think there are, as you said, macroeconomic reasons, you
Yeah.
call that. And
Yeah.
then there are company specific reasons. And the one I point to that I think is very interesting is there was a strategy that was, pushed, I'm going to say about 5 years ago or more. I mean, we all know the Nike stores, right? And those are
Yeah.
great brand, promotion stores. But they realized, oh my God, well, if I sell a pair of shoes at my Nike store for $100, I get $100 of revenue. If I sell it through Amazon, or not Amazon, but would be a good store, Foot Locker.
Well, Foot Locker was really the main incident because they really underestimate the power of the distribution channel of Foot Locker.
Exactly.
And then their fallout with Foot Locker really put them in a bad spot. And then for a period of time, if you walk into Foot Locker and these distribution centers, all you see is other brand like ON, Hookers, and they
Yeah.
have no prime real estate. And you see the Nikes are on the bottom shelf somewhere hidden because they lost this deal. And I think that's a big, big downfall for Nike.
Yeah, this is a classic kind of business lesson or case study, right? Which is, be careful seeing that they were going to get $100 per pair versus $50 per pair from Foot Locker and saying, oh my God, let's really push our direct business. Not
Exactly.
realizing that by pushing their direct business that hard, instead of the Nike stores just being, oh, they're great, come and see all our stuff, but not trying to kind of push aside their supply chain, or I mean their distribution channel. They
Yeah.
went whole hog about direct online sales, all this stuff, and it really bit them in the ass. And that's been, I think, that was kind of the catalyst for what's been a really long-term downward trend in their company. So let's go to the tool. Let's see what it actually tells us. So according to the tool, with the stock trading around $70, the enterprise value based on the most recent quarter cash flow was $63 a share. So what that means is two things. There are two ways to think about that. The cash flow value is lower than what you're paying for it, right? So you're paying a premium to its current cash flow value. So that's interesting, first of all, right? Even though the stock's been down for 5 years, you're still paying a premium to the cash flow value for the shares. That's how bad the underlying business has been, if that makes sense. And you can see last year it was cash flow value of 78. So it had a bad quarter year over year. The cash flow declined from 116 million to 92 million in the latest quarter, right? And that's why the implied value has gone down. Now, what we can then see, what was the basis of that? Well, they only grew sales at 1%, so really anemic sales growth. And I'm going to zero this out for a minute just to have a good starting point. And you can see this. This is still a, I'm going to call it a shit show, which is their cost of sales went from 54.6 to 57.8.
Well, tariff has a lot to do with it too. Yeah.
Well, I think that, well, actually, I maybe tariff, but I think the real driver of that is they're trying to fix the problem they made with their supply.
Sure.
So by trying to give their supply chain deals and kind of get them back on board with Nike, they've had to give up a lot of cash flow. So hopefully for them, it's a near-term, fix that will have a long-term benefit. But right now, it's still hitting their cash flow pretty hard.
Yeah.
So again, you can see gross profit down. You can see operating margins down from 10.4 to 7.9%. And then I'll just briefly say, the question obviously is what's going to happen in the future. If you buy a share of Nike, you theoretically own it forever, right? You're a part owner of the business. If they could grow, we do what we call a trend analysis. If they keep, obviously, if they keep losing profit and not growing sales, the cash flow value is going to go down. But let's say they can grow sales at 10% and they kind of get their margins back to 55%. That would give you a $103 price target based on cash flow. Let's say they do that over the next 3 years. And then you're like, oh, okay, that's interesting. That's a 47% return. So even though it looks overpriced on the current numbers, if they can turn the business around based on what they're doing right now, it actually looks like it could be an interesting buy. And that's what we're teaching how to do. Then how would you do that research? This is a level 1 tool. We can look not only at the overall company, but we can tell you their business in North America is growing a bit. But their business in EMEA, Europe, and the Middle East has been terrible, as has their business in China. So that's where they're still struggling mighty on the top line with both of those regions. And that's kind of, I think, the take on Nike for the moment. I mean, we can anything from you all about your thinking on it, or otherwise.
No, I think you do an excellent job of explaining it. And anybody who signs up for the IVoT Academy gains access to this. So,
yeah, and the Academy's open now, so that's exciting. We just opened up, and these tools are in what we call V1. So if you join our platform, you're going to see, more and more tech coming into these tools, AI, graphics, more and more coming in as we build out our technology. So yeah.
It will also be fun for the audience. Let's ask the audience, hey, what kind of running shoes or what kind of sneakers are you wearing right now, or what do you prefer? That will be an interesting.
Yeah, we see interactive media with this show eventually, right? Where we can do polling while we're on. Also, people can have their own forecaster and be telling us what they think is going to happen. And we can have, here's what the community is saying about what's going to happen. And we can do that with the CFO of Nike on here, trying to defend, their strategy and what they're doing, right? Because suddenly this creates, I think, a much more enriched conversation about how to think about these public companies.
So you can tell with IVoT Ion Investing, we have unlimited different access points and different avenues we can go. Yep. So I appreciate Emile, Andrew. Thank you for your insight today. This is Ed Butowksy, and we look forward to seeing you next week. Bye.
Great.
See you later. Bye.